Hello there, and welcome to our trading community. I'd just like to give you a demonstration of my own personal system. Now, just before I get started showing you this and showing you how it works, just like to point out our trading community is made up of there's 3 traders. We're all professionals, and we all have slightly different systems. We have Dal, who's been trading for 30 years. He was an ex-Chicago floor trader, and he's more of a long-term trader, position type trader. And we have Roger, who's similar to me, more of a day trader, and myself, who I'm more of a day trader and looking for sort of small opportunities but high probability and good risk-reward ratio trades is what I love to find. So what we do is we trade with you every morning. It's in the market training, so rather than theory and reading from a book and watching videos and then struggling on your own when you're trading in the market, we actually trade with you in a live trading room, and we don't hold anything back. We show you exactly what we're doing, and not only that, we also call out our trades, so you get to know what we're trading, and you can also take our trades, and at the same time you can also learn from us. So it's a great opportunity. So anyway, this is my system. Let me show you the basics of it. I've already added some lines in here. The basics of this system is to keep it simple. I've been working on this system, or tweaking, I should say. This system has been tweaked a lot over the years, and really every time I change it, it just is to simplify it further. And one thing with system is you can make them so complicated that you end up with what I call paralysis through analysis. You've probably heard that term. You're so focused on trying to analyze the market that you're totally paralyzed to make a decision. And this system is just simple. So what are we looking at? Well, these bands are a indicator that's custom created by yours truly, and it's called the average range benchmark. And what it does, it just gives you an average range over a given period. The idea being that when a bar closes below the range, we're in a downtrend. So if you watch this, you'll see that when we have a bar close below the range, it tends to trend down. This bar here, this wouldn't be a good entry, and there's another rule that I haven't told you yet, which would actually stop us going short here. But anyway, it still manages to push down a little bit, doesn't it? You see it closes below the band, and we have a little bit of a push down. Not much, probably 20 pips there. About 20 pips maximum. Okay, and then over here, this bar here, we see that we close above the band. Okay, and guess what? Market then proceeds to trend upwards for a period. Does its usual push up, retrace, push up, retrace, gets stuck on a bit of resistance at this level, finally pushes through, and now it's in a little bit of a retrace once again. Usual, typical price action. But you'll notice that as it's doing this, it tends to enter back in the band, as it does here. We draw the blue box. So it enters back into the band. But there's something you notice. It doesn't close below the band. So this is telling us that even though it's retracing, it's not necessarily going to now push right through and go in the other direction. So this is a good way to see that this is not reversing, this is just a retrace in a trend. And the only time we would start to question that is if it closes below the band, which it does over here. So anyway, let's get back to the point. So the basics of the system are, or is rather, that we wouldn't be trading short because we are trading towards this long-term moving average. This is the 150. 150 or 144. Actually, 144 is a Fibonacci number, and this is basically just a little bit more than 144. It's 150. It's a little bit more popular, and it gives you that extra bit of room for overrun. That's why the 150 is used a bit more often than the 144. But it's based on the idea of the 144 Fibonacci exponential moving average. So anyway, we generally don't trade towards it because The idea being is when we're above it, we're in an uptrend. When we're below it, we're in a downtrend. So we're going to be looking only for long trades above the 150. So even though this trade here may have been okay, and if you're a scalper, you may have grabbed 10 or 15 pips here, the risk-reward ratio is not particularly good for this short trade in this area here. So anyway, eventually pushes through the band, closes on the other side. This white line is where we're going to place our entry, and below the bar is where we're going to place our stop. So we have a stop and an entry. It's about 17 pips. Beautiful risk-reward ratio. If we can't get to 17 pips on this trade, then there's something wrong. So anyway, you'll see that the market pushes through about 17 pips, which is about this level. Let's put in a line. We take profit on our first position. Okay, we take 1-to-1, which is half the position. When we open a trade, let me backtrack, sorry. When we open a trade, we open up 2 positions, 2 half positions. So let's say we want to trade 1 lot, we'll open up 2 half lots. We take profit on half the position at this line. Now the reason we do that is because by taking profit on half the position, even if the market comes all the way down and stops us out at this level, we still end up at 0. It's a break-even trade. So there's 2 ways to get to break-even. The first way is to move the stop to break-even. But the problem with moving the stop closer is you actually increase your probability of getting stopped out. So we don't want to do that. We want to try and keep our stop away from the market because, you know, you don't want to keep getting stopped out, do you? That's what tends to happen when you move your stop to break-even. So what we do instead is we leave the stop where it is, and we take half our position at this level, and that means if it returns all the way to the stop, you know, let's say we make plus 100 here, on the second half would be minus 100, which results in a 0 loss and a 0 gain. Anyway, so then what we do is we take profit on our second position at double the distance. So double the distance is about there, about 32 pips. Actually, let's move it down a bit. It's a bit lower. Okay, so where this white line is where we take our second position. And then we're out of the trade. So you'll see that it's very simple. Close above the band, trade long, take half a position. It now has room to fluctuate, which it does. It doesn't ever come in danger of hitting our stop, which is down here. And when it pushes up nicely and gets us to our profit target. And this is a very typical trade. Now, does it ever come down and stop us out? Yes, of course it does. But you know, probability says that, you know, how many times have you been in a trade, it's gone up with you a little bit and then stopped you out? This is what we're taking advantage of. Typically, we always, not always, but you know, more often than not, we hit our first target. Once we hit our first target, we can leave the stop where it is, and it has the room to fluctuate, and we can relax. We're not going to lose any money. We're not going to make any money, so we can let it go all the way to our second profit target. And that's the basics of this system. These indicators all have different meanings, and I'll go into these in a different video, but that's it for the moment. So I hope that was educational for you and gets you interested, because it's a great system. It's pretty easy to learn. It's pretty simple. I'm not going to lie to you, it takes a bit of experience to trade it, as does any system. You're going to have to practice, put in some screen time, and you know, work at it. But once you do, this is a really nice little system. Incidentally, this is a 5-minute chart. It works just as well on a 1-day chart. You'll see that we have a bar here that pokes out the bottom of the band. This is a daily chart, and then the thing pretty much drops you down 1,000 pips if you'd stayed with it. So it's a nice system on any time frame. I just like the 5-minute because I don't want to wait around for a month for a trade. So you know, that's why I like the 5-minute or smaller time frames, because you get more action. But if you don't have time, you can easily trade this on the dailies. Okay, that's it. Thanks for listening, and look out for other videos. Thanks. Bye.